Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to discuss 3 of my biggest holdings going into 2025. I'm investing so heavily in these specific companies because they not only trade at discounted valuations, but they also have significant near-term catalysts to potentially unlock this value already in 2025. But before I get into it, let me clarify that I wouldn't want to own just 3 investments in my portfolio. I know that the title may seem to imply that, but that's not the case. It's important to understand that every investment has risks, and risk factors will occasionally play out even if your investment thesis is correct, and therefore it's vital to diversify your portfolio to protect yourself against these potential losses. But since so many of you keep asking me, here are 3 of my top picks for 2025. So the first company I'm going to discuss here is called Caesars Entertainment, ticker symbol CZR. This is the world's biggest casino operator, managing 50 plus casinos across the US, including some trophy casinos, but also some major regional casinos. Its share price has crashed over the past few years, and as a result it's now heavily discounted, trading at a low single-digit multiple of its free cash flow. But we think that the company has significant near-term catalysts to unlock value. Firstly, its capex will fall off significantly in 2025 because it has now finally finished a multi-year investment program, heavily in reinvesting in some of its existing properties, but also developing a major new casino in Virginia, which just opened a few weeks ago. The management has made it clear that this is their plan. Here's what the CEO said on the most recent earnings call. The openings in Virginia and New Orleans will complete the elevated capex cycle for the company as we now turn to harvesting the investments we've made in these flagship destinations. We executed $140 million share buyback in the third quarter, and you should expect that as we've gotten to our inflection point from a capital spending standpoint, you should expect capex to come down. So in short, what they're saying here is that so far they had to use their cash flow to invest in these new development and redevelopment projects. But now as these projects have been completed, this will free up a lot of their cash flow, which they plan to use to buy back shares, and they've already started to do that, and we expect them to do a lot more of it in the coming quarters, given how heavily discounted their stock has become. The second catalyst here is that many investors seem to forget that Caesars also owns a lot of casino real estate. It's not just a casino operator, but it's also a major real estate owner. It has already sold some of its properties to some REITs like YCHARTS properties via sale and leaseback transactions, and we expect them to do a lot more of that in 2025 to unlock value and free up even more cash flow for deleveraging and buybacks. We think that this will be highly accretive because if you look at their previous casino sales, they've typically sold assets at 7 to 8% cap rates, but their free cash flow yield today is far higher. It's about 2 times higher right now. So by selling assets at a cost of 7 to 8% to redeploy that at closer to 15%, they're earning a significant spread, which would expand their free cash flow on a per share basis. And the third catalyst is the company's digital gaming business, which is expected to really take off in 2025. After years of heavily investing in this segment, they finally broke even in 2024 and began to earn some profits. Their target for this business is to reach $500 million of annual EBITDA already possibly next year. Here's what they said on their most recent earnings call. I think that this business is going to end up generating a hell of a lot more than our $500 million target, so we feel very good about that. We think that this is huge because these digital gaming companies typically trade at very high multiples of their cash flow. So taking all of this into account, we expect the company's free cash flow to surge in 2025, and with a big chunk of that being allocated to deleveraging and buybacks, we think that its valuation multiple is also likely to surge. A major shareholder called One Main Capital has previously estimated that their free cash flow per share could reach $9 per share already in a few years, and this would price the company today at just 3.5 times its free cash flow. And that's quite incredible because even if you tripled its valuation multiple, it would still trade at just around 10 times its free cash flow, which would still be very reasonable for a sector leader with a growing digital business and a lot of highly valuable real assets. By the way, recently the legendary investor Carl Icahn initiated a position in the company, perhaps because they are seeing the same thing as we are. After our recent purchases, Caesars Entertainment now represents about 5% of our core portfolio. By the way, if you want to access the entire portfolio, you can join us for a 2-week free trial at High Yield Landlord. It will be the first link in the description of this video. The second REIT I'm going to discuss is called BSR REIT. Its ticker symbol is HOM.U in Canada and BSRTF in the US. This REIT doesn't have nearly as much upside potential as Caesars Entertainment, but it's also a lot safer. BSR is an apartment REIT that specializes in rapidly growing Texan markets, mostly in the Texan triangle of Dallas, Houston, and Austin. These are expected to be some of the best performing markets in terms of rent growth and asset price appreciation over the coming decade, and that's because they're pulling in a lot of companies, a lot of jobs and people, and yet their rent to income ratios are today still well below the levels of coastal markets, leaving a lot of room for further growth over the coming years. Even then, BSR is today one of the cheapest apartment REITs because Texas is currently facing oversupply, and this is concerning the market. The pandemic initially led to a boom in demand for apartments in these specific markets, and this then got the attention of a lot of real estate developers, especially since interest rates were ultra low at that time. Everybody started building properties all over the place, and now this supply is still hitting the market and it's putting some pressure on occupancy rates and rents as well. But there is some good news here. The surge in interest rates and the high inflation in construction costs has now put most new development projects on halt, and therefore we should see a huge 70% drop in new supply in 2025-2026, and with that we expect a strong acceleration in rent growth. This on its own should be a strong catalyst for BSR REIT, but right as rent growth accelerates, we also expect the Fed to cut its interest rates even further. They are currently expected to cut interest rates 2 times in 2025, and so these two things combined together, accelerating rent growth and rate cuts, should be a very strong catalyst for BSR REIT. Right now, the stock is still trading at a 30% discount to its net asset value. We think that its net asset value is conservatively estimated and also has further upside potential now as rent growth accelerates and rates are cut further. And so if you now expect this discount to close and the NAV to rise a bit, the stock could well have 50% upside potential over the coming years. While you wait, you're also earning a near 5% dividend yield that's paid on a monthly basis, and the company keeps creating further value for shareholders by buying back shares at a discount. Oh, and by the way, here again, we have a legendary investor, a billionaire investor who recently began to accumulate a lot of apartment REITs. Is the billionaire real estate mogul Barry Sternlicht from Starwood Capital. He recently bought shares of Camden Property Trust, Mid-America Apartment Communities, Equity Residential, and many more. He probably isn't interested in BSR simply because it's way too small for the amount of capital that he's putting to work, but we think that BSR is potentially even more attractive than these bigger apartment REITs. And then my third big investment for 2025 is International Workplace Group, ticker symbol IWG in the UK and IWGFF in the US. International Workplace Group is the leading co-working company in the world. Many people think that it's WeWork, but IWG is actually 6 times bigger, operating many brands like Spaces, HQ and Regus. It's heavily discounted today, and we think that this is largely because of WeWork's recent bankruptcy, which has hurt EWG's market sentiment. But in reality, WeWork's problems had nothing to do with EWG. WeWork was simply a grossly mismanaged company that was over-leveraged and failed to turn a profit. EWG, on the other hand, has consistently been highly profitable and has done a much better job at mitigating risks by maintaining a strong balance sheet and also doing things like always setting up special purpose vehicles for every single location to limit the liability risk of the company. And we think that 2025 could be the year when the company finally recovers. And that's because the market appears to have missed just how significantly the company's business has changed in recent years. It went from being a capex heavy business to being a capital light business. And what I mean by this is that historically, EWG would find office space. You would then sign a long-term lease with an office landlord. It would then heavily invest in the property, including the furniture and IT systems and so on, to then run it as a co-working location. That's what it did in the past, but now in the future and presently what it's doing a lot more is capital light. And so what it's doing is that it's signing management agreements with desperate office landlords who want to refill their space. It then makes the office landlord reinvest in this office space to turn into a co-working location, and it will then manage it under a brand of IWG like Spaces or HQ in exchange of a royalty of the revenue. And so this is a much higher quality business because it's capital light, which allows them to grow faster. It has less operational leverage because just earning a royalty of the revenue. It's also higher margin and it earns greater returns on its investments. And the interesting thing here is that the difficulties of the office sector are really a strong catalyst for EWG because it means that there are a lot of desperate office landlords who need a solution to fill up their office space. And so this has allowed EWG to sign a lot of these management agreements, which will allow it to open thousands of new locations over the coming years. Yet, most of these new signings have not yet been reflected in their numbers because it typically takes about 18 months from the signings till you reach revenue maturity at a new location. And so for this reason, we think that 2025 could be the strong year when finally this starts to be reflected in its numbers, because they signed a lot of new management agreement deals in 2023 and 2024. And I think that as this new cash flow shows up in the numbers, it will completely change the narrative about EWG. The market will finally recognize that the business has changed. It has went from capital heavy to capital light, which deserves a much higher multiple of its cash flow. It will also start to understand the growth story that's happening in this sector, and this will allow the company to reprice at a materially higher multiple, potentially leading up to 100% upside from here. These three companies are great examples of what we like to cover at High Yield Landlord. They are undervalued real estate companies that essentially allow us to buy real estate at a discount, and typically they have significant near-term catalysts to potentially unlock this value. And so this could be asset dispositions, or it could be buybacks. Perhaps they're dealing with some temporary issue like oversupply, but we can see the light at the end of the tunnel. Perhaps it's interest rate cuts. There are a lot of different potential catalysts, but that's really what we have. When we can combine low valuation with a strong catalyst, that's a great recipe for strong return. And we own about 20 other similar companies in our portfolio at High Yield Landlord. And if you want to access this full portfolio, you can join us for a 2-week free trial. As I've said before, you won't be charged anything in the first 14 days. You can cancel, no questions asked, with the first link in the description of this video. Thank you very much for your interest. Please click the like button if you thought that this content was valuable. It helps me a lot. Thank you very much, and see you at my next one. Bye.